Welcome to SmithWeekly Discussions, an occasional program for our members of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine our show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion today, we want to say thanks for questions coming from our audience at SmithWeekly, including Nick W., Jake V., Paul M., and Brian H. On the program today is a new guest that we're pleased to introduce. Mr. Doug Bartole is on the podcast. Doug is the president and CEO of InPlay Oil, an Alberta, Canada-focused light oil producer that is currently producing oil from the Cardium formation in south-central Alberta, of which the company is the largest producer in the formation with production of about 16,000 BOE per day and further growth pathways ahead on development. InPlay Oil is listed on the Toronto Stock Exchange under the symbol IPO, as well as on the US OTC markets under the symbol IPOOF. Mr. Bartole, it's good to have you on the podcast for the first time. Welcome, sir.
Well, thanks. It's great to be here chatting with you today.
Yeah, Doug, great to have you on. Certainly, InPlay has been a company we've come across on numerous sources over the years. And of course, a good mutual friend brought us in here, and great to have you on the podcast. I want to get to second quarter operating results in a moment, but you are new to the podcast. And as customary, why don't we have you cover off your background and experience in the Canadian oil sector, as well as how you came to the post at InPlay Oil?
I'm an engineer by trade. I've been in this business for something north of 34 years now. Sometimes forget how long it's been. I started my career back in the late 80s after getting a technical engineering diploma from Southern Alberta Institute of Technology in petroleum engineering. I worked for a couple of years in the fields of the Western Canadian Basin. I went back to the University of Alberta and I got my engineering degree, which graduated in 92. Not the best time to graduate, but I did get a job with Pan Canadian Petroleum in the field at that time, which was a great place to be. I spent 5 years in the field as an engineer. It was a kind of a slow growth area into a really high growth area over that time frame. And, I was able to participate in completions, facilities, operations for 5 years in a very fast-paced environment. Ultimately, I went to Renaissance Energy in 1997 till 2001, and I worked my way up to the head of a 30,000 barrel a day area as we got taken over by Husky Energy. And I became an asset manager of a fairly large area. Ultimately, that wasn't what I wanted to do, and I wanted to get into a smaller organization, and I wanted to be able to learn the whole facet that I haven't learned yet of the business, and ultimately I wanted to be a president of a company. So I went to True Energy in 2001. I stayed there till about 2005, worked my way up to vice president of operations. Back in the day, there was the trust world in Canada. True became a trust, and then we spun out an exploration company called Vero Energy, which I was the president and CEO of at that time. And also came with me as a person I've been working with forever, Kevin Yakachuk, vice president of exploration. So we started Vero Energy. We took that thing from 600 BOEs a day to somewhere close to 12,000 BOEs a day in 2012. We sold all of our gas assets very early in 2012 to a Warburg Pincus-backed company, a private company. We went back down to 1,800 barrels of Cardium production. We grew that quickly to 2,800 barrels a day, and then we exited late 2012 with a reverse takeover of a go public deal for a larger company called Torque Oil and Gas. We started right away with our new venture, which was InPlay Oil. Kevin Yakachuk and I, again, principals, started that. 2013, tough year to get going again. Not a lot of guys started in our industry. We bought a few assets ourselves with our own money, but then we really started kicking off in 14. It was hard to go public. We were looking at some private equity-backed companies, participating or joining up with John Capital here out of Calgary, which is now currently Carbon Infrastructure Partners. Yeah, we started, the real growth of InPlay in 2014. Of course, oil was quite high at that time, $100 a barrel when we started. But we were able to pick up some more assets, grew it up to about 1,600 BOEs a day, brought a few more private equity people in there. We did a few deals along the way, but mostly drilled from that time till 2016. We kind of went drilled from 1,600 to 2,200, kind of averaged 2,000 BOEs a day. But we needed to get bigger. We really worked hard through 2016 to figure that out. And ultimately, we ended up doing a reverse takeover of a publicly traded company called Anderson Energy. We also did a small deal with that transaction. That all occurred late, or second half of 2016, and we ended up going public in 2016 in November. And through it all, like I say, I've done everything in this business, from operations, completions, facilities, M&A, exploitation. I mean, the only thing I never was dug my heels into was the drilling side of the business. So, very multifaceted over my career here in the industry.
Yeah, Doug, thank you for going through that. Looks like quite a diverse background here, and I think that's very important from a leader of your capacity to have those different things across the board. And obviously, you're probably no stranger to drilling, given your time in the industry. So very good information here. Appreciate you walking us through your background and experience. How do you look at the oil market, Doug? Western Canadian Select is around $50 per barrel today. And with that, what are the key items about this market for an onshore Canada operating company in the sector do you look at?
Ultimately, our industry has been a cyclical industry. Commodity prices go up and down and can be volatile both ways at times, many times over exaggerating on the upside and the downside. We got some great basins here in Canada. Some are old, well developed. You know what you got, well delineated, well defined, more conventional assets, but there's still lots to do. There's lots of oil in place. New technology always allows you to recover more oil from these plays. And then we got these world-class natural gas fields, some with oil, some with condensate, more liquids, that have now been developed and delineated, but not even totally, kind of in the Montney and the Duvernay in northwest Alberta, northeast BC. We see ourselves as focused on light oil, and towards medium, even heavier crude over, as we look forward at different things. But the bottom line is we want to stay oily focused. We do see natural gas continue to be a little bit more challenged. I know we do have LNG Canada started up, and then we'll double, and there's some more coming. But there is a lot of great natural gas plays, that are very economic. So, focused on what we do very well, and that's more conventional pools, oil pools. We're looking at do what we do best, operationally very strong. We've led drilling and completions in the plays we're in since prior to COVID, and then the changes that have occurred. We tend to do that in a lot of these areas. And just, as I have a board member who's been in the business 45 years, he says, you guys are just really good. I hate to say it, but you're great plumbers, he says, in this stuff. We know our areas, we know the business, we know these plays, and we're top-notch operators in these plays.
Yeah, it's certainly an interesting market, and the knife cuts both ways, as you said there. And we'll talk a little bit about leverage sensitivities here in a little while. But yeah, very good information, and good to see you guys operating well there in Alberta. Why don't we get into InPlay Oil? The company announced second quarter operating results in August. Cover off some of those results, key items there, as well as a very key acquisition, the completion of Pembina, the acquisition there. And also with that, maybe talk just a little bit about how you expect to finish out the year on production.
Of course, the second quarter was a record quarter for us across the board. It was a solid quarter. Now, we closed that acquisition on April 8th. So we did just over 9,000 BOEs a day in the first quarter. We didn't quite get a full quarter with the new acquisition. We took over operations on the 8th. And again, completely exceeded all of our expectations, our forecasts, both on the base production. We had a nice little beat of what we had estimated, but more importantly, the drilling, the new wells that came on in the first quarter. We drilled 3 wells. There was 4 wells drilled on the acquired assets, with 4 of the 7 wells all coming on late in March. So it was a pleasant surprise of these wells through the quarter. You know, I guess if you go back, we announced the deal on February 19th. West Texas Intermediate was still $72 US for the year. We put out a forecast, a presentation that was our Wall-Cross presentation that we went to institutions with prior to announcing the deal in February. You know, we had a lot of wells to bring back on, and we were actually going to put out our forecast out to the public on April 8th. But of course, April 2nd was that wonderful day, Liberation Day, and 5 days later on the 7th when we closed, we actually hit the lowest WTI pricing of the year at $55. I think it closed a little over 56 that day. But we decided not to put our guidance out. We needed to get some of the noise out of the market, and that happened. So we put our quarter out middle of May, which ultimately we put our new production guidance out. And it was great that we waited, because we had way more overproduction, like I said, both on the base and ultimately on the new wells. Our new wells in the quarter ended up being 135% above our production estimates. Ultimately, we got over 1,000 BOEs a day over our estimation at that time. You know, in the second quarter, it was a low capital quarter. We were doing all the integration. We did not plan on drilling another well until August. So we were actually able to pay off $26 million of debt from step off of the deal in April till the end of June, with the significant amount of free cash flow that we put out. So all in all, it was just a spectacular quarter on our front, and it just set us up well for the rest of the year, in the fact that we went from $72 to $62 WTI. So we lost a lot of funds flow and then ultimately free funds flow. But when we put out our original forecast, we expected to have to spend $80+ million a year. Our new forecast that we were able to put out, because of all this overproduction, was 53 to 60 million. Capitals, we were able to reduce 30% or better of our capital from initial estimates, which was great, and keep the same production guidance. And that was great because it also now reset our free funds flow profile. So keeping the same production guidance, having a strong free funds flow profile, expecting to do, give or take 19,000 BOEs a day for the rest of the year, which is higher than what we originally estimated. So ultimately, we're very happy with the results of our base and our new wells.
Doug, that's great, and you guys are under promising, over delivering. That's great to hear, and you don't get that too often in the natural resource sector, and so that's great to hear that things are going pretty well and firing on all cylinders. Before we get into more discussion on some of the operations and a few other things, I wanted to go into a few admin items here, Doug. Capital structure. Talk about where we stand on cash on hand, the balance sheet, debt position, and then, of course, shares outstanding at the company. Also, the key shareholders on the roster.
Yeah, so after the deal, we did do a 6-for-1 rollback. We have about 28 million shares outstanding, around 1 million options as well, or just under. So on a fully diluted basis, there's no warrants. It's a very clean share structure across the board. We've got a strong syndicate of lenders in our portfolio. They set us up really well. We came out with about $190 million reserve-based lending revolver with that syndicate. And also they put us up with a term loan for 2 years. So second lien term loan, but it is a unitranche, which is solid. It actually has 0 repayment penalty if we hit the bond market and reterm that out, which we have started the work on that as well. As far as key shareholders, so Jog Capital, formerly Jog Capital, are still in with us. They put money in privately in 2014. They put more money in with one of their LPs in 2016 when we went public. These guys have never sold a share. They've been solid, strong shareholders represented on the board since the beginning. Just all in all, like solid, great shareholders. Now, when we did our deal this spring, there was a vendor take back, or the company that did the deal with Obsidian Energy took shares back in us, about $85 million worth, representing 32.7% of the company. They came to us for the deal. It was a win-win for everybody. It allowed them to reduce their debt significantly and focus on their other key growth areas. For us, it was like back in our backyard where we're extremely focused. Like I said, we've been leading the technology changes with drilling and completions. For them, they thought they would have to, whoever would purchase this they'd have to take some shares back. So they came to us. They needed a good custodian, a steward of the property while they held the shares. They were never going to be a long-term shareholder, more like short to medium term. They were never going to, have the ability to put more capital into us. So, we always had maybe a little bit of an overhang sitting there with that. But they were a shorter-term shareholder than we ever thought they would be. They actually, we started talking to a group, the Delic Group out of Tel Aviv. They're a publicly traded company on the Tel Aviv Exchange. About the end of the first week in May, signed an NDA. They went to Deloitte, Netherlands, Sewell, and the reserve side to do their due diligence on us. Kind of got through that. We did our DD with them. Kind of finished through that in end of June when they started negotiating with Obsidian on those share purchases. It got announced, but once it got all closed in early August, we were able to name Delic as the new 32.7% shareholder group. And I can tell you, we are so extremely pleased to have these guys on board. These guys have a strong background. They're a $4 billion US company in Tel Aviv. Two big plays that they have, specifically the Leviathan field, the largest gas play in the Mediterranean, with their interest in NewMed. I think NewMed owns 45% of that field. It's at 23 TCF recoverable gas in place. That also has Chevron as the operator. Then they also, which is kind of more relevant to us, they started buying shares in Ithaca Energy, trading on the London Stock Exchange in 2016. I think Ithaca had some issues, had to restructure it. They did some deals, got it bigger. They ended up taking it private in 19. They then getting it really restructured, doing some deals privately. They went public, got through COVID, went public in 2022, did some more deals, some small ones, and then they merged with ENI's North Sea assets to have a 125,000 barrel a day producer in the North Sea, and Delic owns 52%. So, more of an acquisition model, which is what we follow, which we're going to be following to show growth, because ultimately we have done 3 deals since after COVID, and every one has changed the look of our company and been very, very accretive to us on all the metrics that you'd like to see it. So again, I can't tell you how excited I am to have Delic as a well-aligned, strategically aligned, supportive shareholder going forward. I think it's a real significant advantage that we have over many of our peers of our size in the Canadian space, to have what I would say is a 35% lead order in any deals that we do. So like I say, the stars, the sun and the moon all lined up in the first half of, slightly into the second half of 2025. So great spot to be.
Doug, congratulations on that. To have a group like that come in, super sticky, takes a lot of shares off the market. Just a really good partner to have here as you guys ramp up on growth. So congratulations again on getting that established and that deal done. With that, while we're talking a few admin things here, you guys also did confirm your monthly dividend for September just recently. With that, on the dividend, you guys offer quite an attractive dividend here. You're capturing that demographic of dividend/growth investors that are looking for both of those things in a company. Talk just a little bit about how that is structured against the growth CapEx, the OpEx as well, and then also how you see that dividend from a sustainability standpoint in, of course, a volatile oil market?
Andrew, that's a great question, and it's top of mind to everybody. Now, like this asset we did was a hugely low decline, strong free funds flow asset. So it really helps sustain our dividends on our free funds flow. I think we have over 2.5 times coverage on that dividend as we move forward at $60 WTI. Now, with that said, we have over 70% of our production hedged for the remainder of this year, pushing 60% hedged for the first half of next year and 50% for the second half of next year in that $60+ range, and AECO basis, that natural gas basis as well, that has been doing nothing but making us money through the summer months here. So, we've hedged going forward. As we know, it's still noisy out there. People's views of supply and demand, but there's also so much geopolitical noise. So that's a key to how we look at that going forward. That dividend was put in place in November of 22. It's never changed. It's a monthly dividend, currently at 9 cents per month or $1.08 per year. It's probably about an 8.5% yield today. Ultimately, the key to the whole thing too, is you take a look at this year. Again, it's not a full year with the combined assets. You're sitting there, let's say about 130 million of funds flow. We're going to spend, let's say, lower end of our guidance, which we did announce in Q2 in August when we released that we now expect to be lower end of our capital. So let's say 55 million. We also expect to be on the higher end of our production, which was 16,800 combined for the year. 130 million of funds flow. We're still using $60 WTI from August to December with actuals to the end of July. You're paying about 55 of capital. You got about 26 of dividends. That's somewhere in the 60 to 65% payout ratio for this year. And even when we look at next year on $60 WTI, we're still 65% payout ratio. That'll be the lowest amongst my peer group, and even many of the larger intermediates and seniors. It's one of the lowest payout ratios you see in my space. So we're pretty happy where this is. Now, how do we balance it against growth? Our number one priority, the biggest thing we can create value with at this point in time is reduce debt as quickly as possible. Our goal is to get below 1 times as soon as possible, which should occur sometime in the second half of next year on $60 oil, if that's where it maintains. If it's a little longer, that's fine as well. We don't need to panic with our strong hedge position. Now, ultimately, we'd like to get below 0.75 times before we start looking at, would it be variables? Do we want to do share buybacks if we think we're hugely undervalued? We have all those levers to pull at the appropriate time. Now, we put that dividend in place because prior to this deal, 70% of our shareholders were retail, high net worth, family office type people, and they typically like dividends. Also, we do see institutions would like to see more share buybacks, so we started getting more institutions in there. Delek is fine with the dividends. That's they like that income in the Israeli market. So that's still a key to us, and it's also a key as you're small to hold those people. And we love those people. They've been around with us for so long. We've got so many great shareholders that have been hanging through, through some of the ups and downs, especially after the highest production or pricing I've seen ever in my career in 2022. So bottom line is that was put in place for that. We'll always try and maintain that dividend. Does it increase? It ultimately depends on pricing. It depends on leverage ratios. Variables is probably a better way to be looking at it, and potentially with share buybacks as well as we move forward. I hope that answers the majority of the question you asked there, Andrew, but if I missed something, let me know.
Good information here as we look and analyze this, and as investors listening in, take a look at this company for the first time, or maybe folks in the audience that know of InPlay Oil. While we're on that, because it's related here, it's probably a good place to ask this now rather than later, but Just talk a little bit about the sensitivity of the production profile on the upside, on the downside, shut-in type scenario, just to give the audience really a flavor for the leverage that this company now provides.
Yeah, I think shut-in economics probably don't occur, into the low 40s. WTI pricing, I've seen all the math since the late 90s. Well, since let's go mid 2000s. We had some pretty high prices going into the financial crisis in 2008, which hit commodities late that year, and specifically in beginning of '09. Since that time frame, like WTI has never gone much below $50 more than 6 months. In most cases, it's less than 6 months. So again, we have lots of levers to manage through that, through those type of environments. Specifically with our low decline base, like we can cut capital back for a quarter, 2 quarters, and we can get that production back through the drill bit pretty quickly when the environment changes with pricing, which it always does. Best thing for low prices is low prices. I look at the industry, it's completely different since after COVID. I don't care if you're ExxonMobil or you're InPlay Oil, all of us talk about free funds flow. We talk about return to shareholders. We talk about, well, Bay Street, Wall Street says you guys have been just terrible with money. Equity debt was too easy to access. And, we would spend it for growth for growth's sake. You don't hear growth for growth's sake anymore. You hear return on capital, free funds flow, return to shareholders. It's a common theme, and it's such a better way to run our business. You're seeing in the US right now with the rig count basically quite a bit lower than last year, and it has been continually dropping through most of the year. Much more disciplined, and our goal is to be one of the most disciplined of those companies. We don't need to show, we're going to show growth automatically this year with our acquisition. We're going to have a full year of it next year. We're going to be top tier growth at $60 out of any of our peers. Ultimately, we would expect a 3 to 5% growth on a more yearly basis. Let's say if you're in the high $60, $70, we're in the 3% range, 80 or over, we can be 5% or potentially more, depending on the circumstance. But it's just a different mindset. It's a different discipline. In the meantime, I'm paying people a nice monthly dividend, and we're going to show capital appreciation. And another part of our strategy is that acquisition side. And every acquisition we did was extremely accretive on funds flow per share, production per share, reserves per share. We can create value, we believe, especially with our new access to capital with our new partner. We can create value on it. And for example, like we would have done $4.30 to $4.50 a share this year on a standalone basis, funds flow. We're now, if it was a full year pro forma, it'd be $6 funds flow per share. So on $60 oil. So massively accretive, used a little leverage, paying down the leverage, got those dividend options, variable options, share buyback options, but ultimately rinse and repeat. We can wrap it back up to 1.2 times on a deal, quickly pay down that debt and create value that way as well. So multi-pronged, how we're looking at this.
Appreciate you going through that, and that's very good information as far as how you guys are looking at this and how you take advantage of the market to make some of these moves as well, and then the ability to be careful when you have those periods of volatility on the downside, which, as you well stated there, it's usually quite a short period when those things do happen below those price levels. Just to finish up on the admin side here, key people at the company. Talk about some of those staff and operational folks that are helping to support your lead at the company.
Yeah, I mean, when I go look down the list there, I mean, myself and Kevin Yakachuk have been working together since Renaissance Energy days in the 90s, mid 90s. So what is that? I don't know, 30 years, 20 some years. We've known each other and built, two companies, public companies together. Then I take a look, just kind of go in the order of how they came. Darren Denmark was probably 6 to 8 months after we started, came through one of our board members that he was controller for, that'd be Steve Nikifor. He worked for him prior. Then we had a couple of guys that have now retired, solid people that were later in their career. But in the meantime, we brought up a couple of, I wouldn't say younger guys, but 20-year guys that we brought up, and they've now become vice presidents. Brett Howard is vice president of operations. When we did the Prairie Storm deal in 21, he came over as we brought him in and manager of operations. And then we also, about 6 months later, brought in Rob Jameson, manager of engineering. Both of those guys have now promoted to vice president of operations and engineering. Again, they're 20 plus years in the patch, lots of energy, lots of knowledge, value creation guys. Think very similar to I do. As I've worked through my operation side of my career. And then ultimately we, I guess 2 years ago this month, hired Kevin Leonard, Vice President of Corporate and Business Development. I think he's got 18 years in the investment banking space, predominantly in oil and gas in the Canadian space. It's been a great hire as we got bigger and changed. His knowledge of the capital side of the business through investment banking has been a big help and really leveraging off of that as we move forward. So really strong team. And did you want me to talk about the board a bit here as well?
Absolutely, Doug. Go ahead.
Yeah, so Craig Golinowski, he's chairman of our board. Again, Jaw Capital or currently Carbon Infrastructure Partners. Like I said, those guys have been a great partner. They've been with us since, 14, put more money in 16 and never sold a share. So they've been along with us every step of the way. Then I have other people that have been along with us along the way. We've got Dale Schwed, 40 plus year geologist in the industry, started Baytex Energy, started Crew Energy. He sold Crew last year to Tourmaline. I'd consider the equatorial equivalent in Canada, independent natural gas with strong liquids guys. For $2.2 billion, he sold that for. You've got the next person would be Steve Nikiforik. I actually worked with Steve at Renaissance in the 90s. He worked for prior Grant Figureheim companies in Ketch and Carico through the 90s and early 2000s. He's currently chair of the audit committee of Whitecap in Canada, I think $13-14 billion market cap. He's chairman of our audit committee. Joan Dunn, she another accountant, 45 plus years in the industry, 50 years maybe. She ended her career being CFO of Painted Pony. She's on some private public boards. Again, strong oil and gas background. Regan Davis, I've known since the early 80s when we went to tech school. We worked separately for a while. He brought me into Renaissance and I got moved up quickly there. He went and worked for some of the ARC private equity backed companies and ran a few of them, including his last, both oil and gas and the service side. He took Step Energy, which ARC has a big share in, public. He got them into the US. Again, he's an engineer by trade, just a solid individual. And then finally, we now have our two Delic board members. We've got Udi Yerez, he's chairman of the board of Delic. And we've got Tamir Pulakar, who's the CFO of Delic. Like I say, knowledgeable, smart individuals. We're in contact 2-3 times a week right now, sharing information and planning on different things and stuff. And again, the excitement I have with these guys joining us is second to none. It's something I've never had in my career. I'm at the biggest size I've ever been. I'm enjoying that. Enjoying the assets we have in hand, and specifically what we think we can do together moving forward, and to have them, is spectacular.
Pretty deep bench, Doug. I appreciate you walking through a lot of the folks there. Very good information here. Lots of experience in the various key areas of the market that are absolutely needed to run an operational company such as InPlay Oil. On operations, I want to talk about a few things here in operations, but first, just talk a little bit about Pembina here, Willesden Green, existing well production maintenance, and then, of course, some of that new development activity.
So Willesden Green, it's an area that we got on our initial go public deal with Anderson Energy. We were able to add to it significantly. We got a nice set of assets out of Paramount, which were originally Apache assets. When Apache left Canada and sold to Paramount, we were able to get those Cardium assets. out of there. Ultimately, we also were able to purchase a company called Prairie Storm in 2021, which again added to those assets to a lot of facilities, pipeline access, sales pipeline access. Again, I think that was 1,800 barrels a day. We bought that for, brought it up to 35, double that production. We're basically in free cash flow territory in that. We had to put a little bit more money in facilities in that area. Is the key. It's going to be more of a stay flat for the next little while as we develop what we consider a really high rate of return assets that we have up in the Pembina region. So it'll be stay flat and take that cash flow and reinvest it, in Pembina, and ultimately, of course, for our capital programs and our dividends.
So it looks like the focus is going to definitely be Pembina. With that, I want to have you just talk briefly about the inventories that the company holds presently, and talk just a little bit about that in relation of production life. Tell us a little bit about that and how you look at that.
Yeah, I mean, that's kind of key. Like, this deal changed the future look and the sustainability of our company. Again, low decline asset with tons of inventory. We have easily over 400 locations now, give or take half we would call tier 1 locations. Tier 1 is at $70 WTI, paying out in a year and a half or less, is what we would call that. And ultimately, the majority of those wells, we would say, pay out in a year or less at $70. And in fact, we had 2 wells that came on in March, were paid out by the end of June in a $60 oil and price environment. So it really stepped that up. Now, we got another 200 of what I would say are tier 2, so longer than the year and a half at 70. And I think we're using conservative metrics when we pricing and conservative type curves when we look at that. But those 200 locations, I would believe, as we delineate specifically some of the new assets, which were hugely underdeveloped, we'll start adding tier 2 inventory into the tier 1, so we'll get some of that moving down. But ultimately, our tier 1 inventory has 10 to 15 years of inventory when you take a look at our current plans of drilling, depending on, when it's a little lower and you're trying to stay flat to, trying to show upwards of 5% growth rate organically. That's huge. I mean, we probably had, let's say, give or take 4 years of that on a standalone basis. It lowered our decline, which is very important, which provides the significant amount of free funds flow we generate. It has a proved, developed, producing reserve life index. So that's our blowdown case. If we never drill another well, of over 7 years. That's one of the highest of my peer group. We're 14 years on approved. So that's taking where the reserve evaluators give us a probability of 90% of hitting those numbers. And we have about 19 years of proof plus probable, or 2P. So that's just another level of undeveloped locations that they risk a little bit higher, but also, give it a probability of 50% of hitting those numbers at this stage. And we believe that probability moves up to closer to 90 over time. So again, massively changed the look of our company, the sustainability, the inventory, right across the board, a game changer, scale, everything. Got a lot of facilities that came involved with this. There's lots of synergies, lots of cost savings that come, significant amount of facilities in Pembina that are tied specifically into sales line. We're going to be taking sales pipeline systems, which we'll be taking advantage of, and a significant amount of natural gas takeaway facilities.
Doug, very good. And even on a conservative basis, a lot of runway that you guys have established. So key feature of the company. With that, completions and well design. Talk a little bit about your guys' key means and methods that you're using that provide a competitive advantage.
Let me just finish one thing on the other piece of the tier 2 inventory. And ultimately, I think many people are like me. You're going to need to have $80 or $90 WTI, maybe higher at some point down the road, as we do believe demand will continue to grow for many years. and the product needs higher price, or oil will need higher prices, significantly higher prices for people to, get to tier 2 inventory. Even like there's a lot of talk about the tier 1 inventories getting drilled up quickly in the Permian. So that tier 2 inventory ultimately becomes, less than 1.5 year payout at, $80, $90 type WTI. So we'll leave it like that. And now I'll get into you can see I'm excited about some of this, but I'll get into the drilling and completions. We, again, back in Vero days, we grew in less than a year our production after we sold our natural gas in 2012 from 1,800 to 2,900 in about 10 months. We've been leading drilling and completion changes. Back then, we're well versed in the Cardium. When we took over our assets and started drilling, we've never been scared to try different things, drilling our holes differently. But again, in the end, that's important. You can get some great savings there, but it really becomes even in the shale plays, it's your completions and your completion design and how you handle that. We were the first ones to go from boulder op to what they call sliding sleeves in our play. We played with the spacing of the sliding sleeves. We probably were as high as 80, 90 meter spacing and as low as 30 meter spacing between our fracs in these horizontals. And again, we're drilling 1 to 2+ mile horizontals, but predominantly the longer ones, 1.5 to the 2.2 mile wells. We ultimately figured out that our sweet spot is about 45 meters. You start over capitalizing when you make it a little bit too tight, and the combination of return based on production reserves. Well, results when you get too high out is when you get too wide a spacing. 90, 100 meters isn't there neither. So we figured that out. We figured that out nicely before COVID. We changed even our sliding sleeve methods of how we do it, which again and we tried some different companies, which again leading that charge. Now I would say 80+% of the companies in the Cardium are using our drilling and completion techniques, specifically on the completion side. Yeah, and then I guess the key with our new assets was, again, it was not the focus of the prior operator of those assets. They had a different focus. They drilled a lot less wells than us, so they were not focused and taking a look at the details, how we would look at it, and ultimately they did not drill a lot of wells. So we had this whole new land base that's massively underdeveloped, which ultimately you see in our inventories that we talked about.
Appreciate you walking through that, because some of those techniques by experience are very important here and definitely helps bring down the capital expenditures on this as well. So very good information on that. Appreciate you covering that off. And of course, the adoption of some of your guys' means and methods there at other companies within the area there in Alberta. With that, on Alberta, what's your interest level here? What's your appetite to look at other play areas within Alberta? And then also, is there interest in any other province?
As I mentioned early, and I'll elaborate on it. Yeah, I think we're focused on more of the conventional assets. It'd be very difficult for us to get into the Montney and the Duvernay. You've got a lot of great companies with great land bases, and they're going to tend to be the consolidators of that play. It's an expensive play, right? Your well costs are 2 to 3 times our well costs. You got infrastructure issues that again requires a different size of company and a different appetite, where there needs to be lots of big facilities built. So if you've got the capacity, you do it yourself. If you don't, you're going to a midstreamer to build it. You got a massive take or pay commitment to go with it. So yeah, we see a lot of opportunities. We see on the conventional oily side through Alberta, eastern Alberta, even parts of central, north, western Alberta, but tons of opportunities still across the basin. Large oil in place, low recovery factors, are something that's very highly engineered and looked at. But also, there's things to do in Saskatchewan as well. Saskatchewan has lots of pools that still, have a lot of oil that's remaining in place. I also, you got to love large oil in place, and specifically with low to medium sort of recovery factors. When you take a look at the Pembina field, which we now have the largest land base, we are the largest producer. When you take a look at that field, it's the largest conventional light oil pool in Western Canada with 11 billion barrels of oil in place. I mean, every 1% extra recovered out of there over time is significant. And that pool was found in the 50s and 60s. It was delineated with vertical wells in the 70s and 80s. It had strong water flood put in place through that time frame. It was all with vertical wells, but it was mostly at the top of the reservoir and the highest quality of the reservoir. And there was a lot of oil below that top, let's say average 5 meters of reservoir. And that's what again, with technology, we're going to the bottom of the reservoir and we're drilling at the very bottom of the zone and fracking up. And we're getting all the oil that was never produced, and we're getting a lot of the oil that was never produced in the vertical wells. And ultimately, we're hitting the nice spots in the upper high quality reservoir that have banked oil, that have high pressure spots that just have not been recovered with the vertical water flood. So again, it's been around, 70 plus years. I believe the Cardium field will be around another 70 plus years from now. So, these are the type of things we're looking at and using our expertise around and creating value that way.
Thank you for covering through that and how you guys are looking at this and where you see the opportunities there within Alberta and Saskatchewan as well. Definitely would be on the radar. Good jurisdiction to be in, Doug, when you look at Canada. And of course, how Alberta's natural resource wealth is helping to support Canada as a whole. Well, Doug, just to be respectful of your time, I think we'll wrap it up for now on this introduction of InPlay Oil. Really appreciate you coming on and talking to our audience. For potential investors who are listening, and the company has a market capitalization of about 345 million Canadian dollars. Why should InPlay Oil be considered within the institutional, family office, and retail investors' portfolio at this stage?
That's a great question, Dan. And in reality, we have a track record, and you can see it in our presentation of production, reserves per share growth. And if you do that consistently, you're going to create value. Commodity price will move up and down, but you'll create value for your shareholders as long as it's not all leverage, you don't blow it up. We're very focused on that. I think our disciplined strategy is a key. Again, every deal we've done has shown per share accretion on the key metrics. You take a look at where we sit right now amongst our peers. We're paying an 8.5% yield while we're delivering on what we say we're going to deliver, reducing debt currently. Very confident we're going to get more accretive deals. We're going to get larger, which will get us into hopefully more institutions to take a look at us, above and beyond the great support we've seen from the high net worth retail, family office investors that have been sizable supporters of us for many years now. So we're paying you, a nice stipend while you wait, while we continue to execute and, grow our company and create value. And we're torquey, right? I mean, we trade at lower cash flow multiples than historically the industry has. You get oil price and multiple expansion on cash flows, you're going to see it very torquey. A lot of the seniors are trading a lot closer to historical cash flow multiples. When you get larger and you get the institutions coming back in, and they do, we've seen it in 21 and 22, you're going to see, I think, some torque behind our name.
And for further information, what is the best way for folks to make contact?
We have a general info line. Scott Coage, many will know, and he can be contacted. Scott, he's in charge of our investor relations, Scott K at InPlayOil.com, and you can reach directly out to myself as well, or Kevin Leonard, the VP Business Corporate Development side. So we're always going to try and get back to everybody.
Mr. Bartole, great to have you on today. Thanks for the introduction of InPlay Oil, and good luck on operations, and we're looking forward to having you back in the future to update.
Thanks, Andrew. It's been a pleasure.